My name's Dan Welch, and I'm with Cornell University, Dyson School of Applied Economics and Management in the S.C. Johnson College of Business. And I'm here today to talk to you a little bit about risk management, crop insurance, and some record-keeping tools. And the reason for this is, in addition to NOFA's work with risk management, Cornell also has a project which RMA calls the Targeted States Program. There's a dozen or so states where they think that more farmers should be using crop insurance as a risk management tool. New York is one of those states, and some of the reasons for that are that we grow a lot of specialty crops, niche kind of crops that crop insurance, as it was originally designed for corn, soybeans, wheat, might not always be the best fit. But I'll talk about some other programs that should be of interest to you. Okay, so this is a quote from one of the farmers that bought crop insurance, and it doesn't tell you anything you don't know between 2016 and 2017 in terms of dealing with weather, having to go from pretty hot, dry, drought kind of conditions in a lot of the state to not being able to plant things until the 4th of July in other parts of the state this year. So we're going to start off by talking about a general framework for risk management and how we like to think about it, and some of the categories that USDA uses to break down risks that farmers face. Okay, so we'll talk a little bit about why there's a need for risk management, what are some of the types, have you do a little exercise to evaluate some of your risks, and then discuss how do you manage those risks and how can you develop a plan to put that into action. Okay. So hopefully that shows up. I know sometimes this PowerPoint template gets a little small, but this was from Farm Futures, and it has top 10 reasons why farmers don't manage risk. You know, one of those is there's no free cap or jacket. A lot of, oh, there we go. Somebody's got a cap in the audience. You know, sleeping too soundly would make my spouse wonder what was happening, if everything was going all right. And then life would be dull without daily doses of fear. Now, you know going into farming that there's going to be risks. And farmers in general have, I think, a relatively high risk tolerance to even contemplate it and then go into farming, because you're battling a lot of things that you can't control. Mother Nature, diseases, insects, weeds, all those things that they just do their own thing sometimes. So we can talk about risks in kind of 5 broad categories. Okay, so one of those, oh, well, that's not the pointer. With the picture of the vegetables there, that's to represent production risk. It's probably one of the more obvious ones. There's also financial risks that you face. Down there in the right-hand corner with the farmer's market, there's marketing risks. There's also human resource risks, and then legal risk. Okay, and we're going to break those down a little bit. But can somebody give me an example of a production risk? Weather. Yeah, weather. That's obviously one of the big ones. You know, it could be Could be disease, like you get late blight on your tomatoes and wipes them out. What about a marketing risk?
Just competition, not knowing, you go to market with a certain product and somebody's selling it for a lot cheaper. And you're not gonna sell as much.
Right, so she would just say in competition, you go to market, you have a similar product to somebody else in the stall near you, they start cutting their price, and then you're like, ooh, what do I do? So that's definitely something to consider. Human resource risk. What's that? Yeah, so the example there, somebody gets hurt. Maybe it's a key employee, somebody that you really rely on during the season, and now how are you going to get their jobs done? Another thing that, when I'm not talking about crop insurance, I do a lot of work with succession planning for farmers, and there's a lot of human resource risk there in terms of the relationships between different generations and how you're going to develop a plan to transfer ownership and management of the farm. What about a legal risk? Yeah, right. You can go back to someone gets hurt on the farm, especially if you're doing a lot of tours or you have a corn maze, something like that, hay rides, all things that people can get hurt on and potentially open you up to a lawsuit. Okay, and then financial risk. Financial risk. So he's saying the rise of veganism. So you're a livestock producer? Eventually, okay. Yeah, so that that might be something that you got to look at long term. Another financial risk that a lot of farmers face can be just trying to make your payments on the farm mortgage, or if you have an equipment loan. And if that gets out of whack with your cash flow coming in, that can be a risk. Okay, so this just goes over a little more detailed production risk. So we've got weather, we discussed that. You could have problem with supplies. The seed that you wanted, they had a problem, you're not going to get it on time, you miss your planting window. You could have issues with machinery. It was in the hops session, no, not hops, the other H, industrial hemp session, and the researcher there was talking about how their combine broke down, engine blew, took 3 weeks to get it back, and the crop was past where it should be at that point. Any other examples? Yeah, disease. Yeah, all those pests, bugs. Yep. And it's especially for those of you that are organic farmers, that presents a whole other set of challenges, because you can't just go in off the shelf and say, oh yeah, I got this bug, I'll get that insecticide on it and we'll be good to go. It doesn't quite work that way. So marketing risk. You could be experiencing loss of markets. It could be something like the farmers market's getting overcrowded. They say, we don't need you as a vendor. What's happening now in the dairy industry in the state, and actually across the Northeast, is we have too much milk. Too much conventional milk, too much organic milk. And some farmers are saying, you're not going to have a guaranteed market for this milk because we can't sell it. Decline in prices received. That's a big one. You know, you experience it a little bit, I think, on the organic side, and things like competition, more supply in the market. You're not as exposed to some of the things that commodity growers have to face with global markets, prices of futures going down or going up, which adds to a lot of variability. Weather. So if you're in a business where you're relying on people coming to the farm, or even, you know, like farmers markets, if it's a rainy day, they're not going to be showing up at the farm. They're probably not going to be going to the farmer's market. You get your few diehards that will, but you may not get as many casual customers coming through it. So that's also something to think about. Anybody think of any other?
What you grow isn't selling.
Yeah, sure. Yeah, you know, trying to keep up with consumer tastes and having the right crop or the right cut of meat at the right time for what people are looking for is definitely a little tricky. And another thing that sometimes can come into play with this is what's happening with a certain kind of crop. You know, there's a food safety outbreak or E. coli, like with the recently with the romaine lettuce. In some consumers' minds, that means, oh, all romaine lettuce is suspect. And you got to deal with that sometimes. Okay, financial risk, decline in profits, because I know you all got into this to make lots of money, right? Big bucks in farming. Another one is financing, so either not being able to secure financing, certainly a challenge for a lot of beginning farmers, or it could be an established farmer where you need that next size tractor to get where you want to be, or you know, you need a better place to pack out your produce. You know, one of the other things to think about there is interest rates and how does that impact your debt over time and what your payments are going to be. So all things to consider. Does anybody have another one?
Lease land, at any point, you know, things can shift them. You sign a contract, but sometimes there are other things that are written into a contract or not written into a contract, or even at the end of your lease, if you've put a ton of money into improving and capital expenditures on there, and then you get kicked off your land, makes that pretty interesting. There's a lot of risk in that.
Yeah. Right, and so the example she gave was a lease where, yeah, you got the contract and you're really super excited the day you get the lease, so you kind of glance over it and you didn't read all the fine print. So you then, you know, you're doing your capital improvements and something changes, whether it's the landowner just gets grumpy one day, or a lot of times I deal with situations where senior generation was really happy with the lease arrangement. They weren't really looking for a lot of money, let's say. They just were happy, oh, somebody's still farming it. And then either through incapacity or they pass on, that next generation is now the ones who are holding the lease, and they're like, I think we're going to sell. And so they're going to say, okay, yeah, you got 30 days to leave.
A younger family member that wanted a farm.
Right.
And they kind of just nudged the farmers off the land.
Yeah, that happens. So definitely there's some financial risk there, especially if you've made those capital improvements. And that's also one that goes on, well, not that one, but a legal risk too, because contracts are involved, and how those contracts are written can really make a difference. So people risk. So we talked about labor. You know, somebody gets hurt. Are they showing up? Are they showing up for a full day? You know, those kinds of things. Another people risk to think about is what's going on in the family or your friends who are helping out. Like, I know sometimes, especially when you're in those beginning stages, you get a lot of volunteer labor from your friends who think, oh, this is really neat. This is kind of cool. And by the end of the month, they've decided that hand weeding is not that much fun. So you want to think about that. You know, also relationships with the spouse, significant other. Is the farm taking a toll on that? So those are all things to think about. Okay, legal risk. So, you know, the big one we think about here is lawsuits. Mentioned that earlier about somebody gets hurt on the farm. Could be a lawsuit if you are involved in some type of food safety outbreak. Another big one that comes up with legal is regulations. Okay, and how are changes in regulations impacting your farm? What do you have to do differently? So all of you that might be dealing with Food Safety Modernization Act and having to come up with your farm food safety plan, that definitely had a big impact on your operation. Could see it something also with the organic rule that they delayed on the treatment of livestock. If you had already put in a lot of time thinking this is how it's going to be, you've invested that money. Now, you know, does that harm you? Could that capital have been deployed in other ways? Any other legal risks? Another one that I heard in the workshop today to also think about that, you know, and usually when we're talking about regulation, we think about what's happening at on the federal level with the United States Department of Agriculture, but it could be a local issue. Is the town zoning board going to let you put up a roadside stand where you want it to be? Or are they going to say, no, that doesn't comply? And then how much time is that going to take you to get through that issue? Okay, so I know we had a few people coming late, but those of you who got early, you got a little risk management checklist. That's bluish on top. I don't know if I have hopefully I got enough there. And let's just take, I know it's probably going to be a little awkward for the video, but again, I didn't want you listening to me the whole time. Let's take 2 minutes, and you probably won't have time to go through all of it, but just scan that, and then let's talk about what are some of your big risks that you think you face on the farm. Yeah. So under each of those categories that we just talked about, there are a few examples of those risks. Okay, I know you haven't gotten through all 4 pages of that, but does anybody have one that they noticed, maybe like one you hadn't thought about before? Or is there one that you maybe aren't sure how do you manage that? What's that? Oh, so the question was, I thought there wasn't crop insurance for organic farmers. We are going to get to that. We do have a crop insurance policy that'll work. Okay, well, that's something you can take home with you, review it, you know, a little more in depth, take it home to other folks that work on the farm with you to get their input. But it's a good way to start kind of seeing what are the areas that you maybe really want to concentrate on. Depending on your operation, what are your larger risks that you need to immediately kind of start managing? Okay, so some things to think about in terms of helping with risk management. You know, on the financial side, having good financial records. On the legal, sometimes the people side, insurance could be valuable. Thinking about contracts and well-written contracts, on legal risks, and, you know, just in general, having a good business plan or strategic plan that lays out what are you trying to do with your farm, how are you going to get where you want to go, and then along the way, how are you going to manage some of the risks that you've identified. Okay, so this isn't really rocket science. You know, as we went through the categories, all of you know that weather is a risk, you know that pests and diseases are a risk, you understand there's financial risks. But also be thinking about some of those ones that you may not be thinking about that are right at top of mind. Some of the ones that might be hidden a little more. Okay, so now we're going to go through crop insurance. Have any of you used crop insurance before? Not surprised. Just wanted to ask. But so we're going to go through some of the basics of crop insurance, how to address some of the record keeping requirements, and then we're going to talk about some specific policies that could be really helpful for organic farmers. Okay, so in general, crop insurance is designed to help farmers manage their risk. It's not really designed to be a way to make a lot of money, which sometimes that's how farmers evaluate their crop insurance participation, and if they're going to participate in the next year was, did I get a good payout or not? But if you think about it, it kind of operates like a lot of other insurance products. So you pay an annual premium through a private company, okay, and if you go to the Risk Management Agency website, they have a crop insurance agent locator on there. So you pay part of that premium to that crop insurance agent. The federal government pays to that company a subsidy that covers their part of your crop insurance. And then if, depending on the type of policy you have, if your yield or revenue falls below the insurable level, because it's something that's covered, you get an indemnity payment. Okay, so if you think about crop insurance kind of like car insurance, okay, you got to pay that premium, whether it's monthly or quarterly, and then if something bad happens, you file a claim. And that money that you get back from the insurance company hopefully makes you whole, or, you know, sometimes with a car it's not completely whole. And same thing with the crop insurance policy. It depends on what kind of elections you choose. But you're with car insurance, do you expect to get a payout every year? No, okay, because you generally want to avoid the deer. You don't want to get into an accident. So that's where it helps to have that mindset with crop insurance too, that yes, you're paying into it every year, but you may not get a payment every year. So the most common policy is what they call a single crop multi-peril insurance. Okay, so you're buying a policy for a single crop at one time, and you can buy it for either yield or revenue protection. This gives a list of what's available in New York. So you got your grain crops there, your barley, corn, silage, soybeans, wheat. Then there's several vegetables you can do: cabbage, dry beans, green beans. And then for fruit, apples, grapes, peaches, and tart cherries. Okay, so one of the decisions you have with crop insurance is what coverage level do you want to buy? The basic level is called catastrophic, or usually abbreviated as CAT level. This is the cheapest option. You only have to pay a $300 administrative fee, but it only provides a payment when you have lost 50% or more of the harvest. Okay, so that's why they call it catastrophic, because most of the time, if you lose half of your crop, you're going to be hurting pretty good. So in 2017, 12% of the policies were CAT coverage, and indemnities are pretty rare, because if you think about it, in most years, it's going to be pretty unusual that you lose 50% of an entire crop. So the next level of coverage is buy-up, and here you can decide to purchase more coverage up to 85% of your yield or revenue. The premium subsidies for these decrease as the coverage increases. Okay, so basically, the federal government is putting in less money because it's becoming more likely that you'll have a payout. So your decision here kind of has to balance higher premium cost with a higher likelihood of having a payout or an indemnity when you have a loss. Prevented planting. This is a big one here in New York, especially after a year like 2017. Most of the policies have some special provisions around prevented planting and replant. These are only usually available under the buy-up options. They're not available under CAT or group risk policies. The prevented planting guarantee is 60% of the production guarantee purchased for timely planted acreage. You may be able to get higher levels of coverage for the prevented planting. And what they mean for timely planted acreage is that on a normal year that you're planting when you should be for your location and the crop that you have. So if you normally plant, let's see, the peas there for processing peas. If you're planting those in late April, early May, usually that's fine. If you decided to, I'm going to try to get a real jump on this and I'm going to plant them at the end of March, and they don't come up, that's not a preventive planning. Preventive planning would be, I wanted to plant these the first week of May, but it rained all May, and I couldn't get them in until June 15th. In each of the policies, there's some different windows for when you need to notify your insurance agent about a claim. And then several of the policies include replant payment, which is equal to the lesser of the actual cost of replanting or a formula provided. It gives an example there of the corn replant formula, which is the projected price per bushel times 8 bushels. So trying to reimburse you a little bit for the cost of the seed that you already put in the ground, and fuel for the tractor, that type of thing. Another type of insurance that we're seeing more use of here in New York is called Pasture, Rangeland, and Forage. And it insures livestock growers against a lack of precipitation. And it can be either rain or snow relative to historic levels. And this is done through remote sensing. USDA has a grid system where they're tracking precipitation. And if you're in a grid that has lower precipitation, you automatically get a payment if you have this insurance. And the idea is that it will enable you to buy supplemental feed when you don't have enough forage available. No record keeping is required because, again, they're doing this on the grid system, so they're looking at what the weather data is, putting it on a map, saying, oh, yeah, your pastures are here, you should have gotten more rain.
Is that a constant amount over time, or is that like if there's historically low levels for an entire season, you just keep getting paid?
It depends. Let me see if they don't have it. So for this, you select months that you want coverage for, and if you have that month covered and it's low precipitation, you'll get a payment. I don't know if there's any annual cap on it, but you do want to think about where you are in terms of, or where the amount of precipitation your farm gets versus the rest of the grid. So if you're in an area where for some reason you have low rainfall, I don't know, you're up on a hill, the rest of the grid's down in a valley, they get a little more precipitation, you may not get that indemnity, even though it's dry on your farm. If the entire rest of the grid is wet, you won't get a payment.
What if you're crop pasturing? Or silvopasture? So it's pastured land that's also used for...
That's a question I don't know the answer to. I'd have to get back to you on. That is a good question, though.
Like, how big are the squares of the grid?
The grid, it's like on a 4 mile or 5 mile. So they're not, they're not real precise. And don't quote me on the size, but it's a fairly large-ish kind of grid when you're thinking about precipitation and some of the things, that I hear from farmers when, during the summertime, the half a mile down the road, they got an inch of rain and I got nothing, something to think about. And it's also not tracking the precipitation like on a daily basis. It's based on these coverage periods. Any beekeepers in the room? Okay. Well, just to make you aware, there are some insurance options for beekeepers. It's actually under the Pasture, Rangeland, and Forage. There's a little subsection of it for beekeepers. 3 policies were sold in 2017. And they can also use whole farm revenue protection, which is what I'm going to talk about next. Oh wait, first I'm going to talk about APH. Then I'll talk about whole farm revenue. So actual production history insurance, or APH, is available to most of the crops in New York. And it works as a single crop policy that offers protection for, various types of crops. And it covers yield losses that cause production to fall below your historical production levels. And some of the losses can be caused by adverse weather, fire, wildlife, insects or plant disease, if you've done everything you're supposed to. So on insect and plant disease, you could have, I'll go back to late blight. You could have a real bad year with late blight, but if you didn't try anything to prevent it, they're gonna say, hey, you weren't using good management practices, good cultural methods here, so that's not gonna be covered. But if you've done something, you tried to, I don't know, in organics, maybe you tried some copper applications and it still didn't work, then that could be covered. Okay, so what is not covered? It's just for yield.
What's the time span for historical production levels? What is it measured against?
Oh, it's a 5-year historical average.
What if the farm's only 4 years?
So, yeah, for beginning farmers, there are some provisions, but to get APH is pretty difficult. So what they do in that case is they measure your yields and compare them to the county yields, or you measure your yields and compare them to the county level. So for each of these single crop policies, the risk management agency has determined a county average, for apples or corn, and that's what a beginning farmer usually uses. Now, the problem with relying on the county levels is sometimes they're already lower than what your production is. So you may have had a significant loss, but you're still above that county level. You're not going to get an indemnity payment. Same thing on the other side. Let's say they're high and you're usually a little bit low. They may say you might not, well, I guess in that case you'd probably still get them, but you got to think about where you are and do a little research into what that county yield is. Okay, so under an APH policy, it's only for production risk, not price risk, not market risk. So if you can't market your cabbage, that's not covered. And losses due to poor management practices are not covered. I talked about it a little bit with the insects or plant disease. And that comes up to, like I mentioned, with the preventive planning. Okay. So this is an example for cabbage insurance. Are there any big cabbage growers in the audience? This just gives you an idea of how it works. So if you, let's say their yield was 400 hundredweight per acre of cabbage, and they're at the 65% coverage level, they would get a guarantee that they're going to get a payment at 260 hundredweight per acre. And all of these, I'm going to show some more examples. These premium rates are kind of estimates. You can only get a insurance quote from a crop insurance agent. Okay, so one of the things that might be valuable for organic farmers to look at is whole farm revenue protection. And what this does is it allows diversified farmers to insure their whole operation with just one policy. Okay, because a lot of you, especially if you're in vegetables, you're growing 20 different things maybe. And it would be really hard to get a policy on all of those. And a lot of those, in New York, you may not even be able to get a policy on. So if you're one of those diversified farms, you get a higher premium, subsidy, and lower rates. Schedule F tax records are required over the past 5 years because, again, this is a revenue policy, so they want to look at how much money have you made over the last 5 years. And they can cover all crops and livestock produced by a farm. One of the things to think about if you're highly diversified is the record keeping challenges, because you're going to have to keep records on what your revenue is from each of those crops, which may be difficult if you're going to the farmer's market, you brought 10 things with you, and it's all going into one cash box because, you know, on Saturday morning, it's really hard to take the time to say, well, I just sold $5 of potatoes, and then I sold $6 of cherry tomatoes. That can be tricky. So far in New York, the usage is pretty low. So there were only 15 policies sold in 2017.
So you're saying that a farm has to be in business for 5 years to buy this policy just from the get-go?
Right. There are some provisions for beginning farmers, but I gotta see if there's a slide with that. It's a little trickier if you haven't been in business for 5 years.
So let's say you have a dairy cow. Are you covered for, and the cow, several of the cows are killed, are you covered for what you generate revenue that year from that cow milk, or the worth of that cow the subsequent years?
It would just be for that year. If you were in like a dairy situation, it would be the revenue that you lost in that year, not for the out years.
Similar for laying, just the eggs.
Right. Yeah. Right. So this, another thing I should say about whole farm revenue protection, right now it's in pilot status, which means that they're still trying, the risk management agency is determining how effective this is for farmers, if this is a policy that they should offer going forward. So they are looking for any feedback. If you do consider this in the future, they would like to know how it's working for farmers. So this shows where some of the policies were sold. You'll see the most number was sold in Wayne County. Some of our experience is starting to show that there may be some benefits for tree fruit farmers to participate in whole farm revenue as a risk management tool. Okay, so
Experiment in New York, the pilot, or this is
it's a nationwide pilot. And it's available in all New York counties. I don't think I mentioned with those single crop policies. So let's say grapes. So grape coverage was available in the Finger Lakes and way out in the Lake Erie Grape Belt, out in Chautauqua County. It hasn't been available in the Hudson Valley. Well, there's a lot of wineries that have gone in the Hudson Valley recently. So we're actually starting to get some information back to RMA that maybe they should add those counties. What's good about whole farm revenue is that it's available in all counties. So you don't have to worry about, is this crop in or out? So some of the dates. The sales closing date is March 15th. That is the same as the closing date for a lot of the spring planted crops. If you're an early fiscal filer, which for the most part, most of you would be, they do have a November 20th for late fiscal filers. And that's about, did you decide to have a January 1 fiscal year for your business or a July 1 start date for your fiscal year? Most everybody does January 1 because, start of the new year, it's simple. Acreage reporting is due by July 15th. So you have to tell your agent, this is how much of each of the crops that I planted. And then your bill comes on August 15th. So that period is, again, your tax year. And that's why they throw in the thing about the fiscal year. So if you're January 1 to December 31st for your fiscal year, that's the insurable period. CAT coverage is not available for this policy, so you have to get some type of buy-up coverage. And it does have replant provisions for annual crops if they're not covered by another federal policy. And it's equal to the cost of replanting up to a maximum of 20% of the expected revenue. So if you were, your expected revenue was $100,000, you get $20,000 towards expected revenue for the maximum. And it kicks in when 20% or 20 acres of the crop need to be replanted.
How does that work for tree crops? So are you replanting the perennials, or is it just the yield for that year?
So this is just for annual crops. So if you're looking at trees, nursery stock, FSA has some programs that kick in, but they only kick in if there's been a disaster that's been declared for your county.
So how did those farmers up in Wayne make it work? You said that those are the ones they had tree producers?
Right, so they're already producing fruit. So what they're getting, and that's where the policies have sold. We don't have information yet on if they got a payout or not, but it would be the difference in either their expected yield, the difference in the revenue, whether that was from a yield issue, I just didn't have enough apples this year because we got hail damage, or it was because the price of apples dropped.
What if you're renting that land, or you're renting those trees? Is it still the revenue based on what you expected that you're renting it? No.
I don't know if you're renting the trees, how that works. You got a lot of good questions today. A lot of things for me to follow up on. Okay, so we put this example together of a diversified farm. So they qualify for being diversified, and so they can protect that revenue of $230,575 at the 85% level, and then they get additional premium subsidy for a diversified operation. So when you look at it, they would have insured revenue of about $196,000. and their estimated premium would be $11,469. So you got to think about, okay, is what I'm going to pay out in the premium worth knowing that if something goes wrong, I can at least still have $196,000 worth of revenue. Another thing you have to think about with whole farm revenue protection, because you're insuring multiple crops, is what happens if you have crop loss in one, but it doesn't really impact your revenue significantly. So let's see, they got aphids on their sweet corn, and they had a yield loss of 50%. All other crops were right where they should be, and prices remained average. So the revenue now is $201,000. Okay, so it dropped almost $29,000, but it didn't drop to that insured level of almost $196,000. So bad year for sweet corn, but you still wouldn't get an indemnity payment. Now, it could be, depending on the value of the crop, maybe one crop loss is enough to trigger that payout. So you get worms in your cabbage, it reduces the yield by 30%, everything else stays the same, and now those significant losses have reduced the revenue to $150,775. 150,000. So that's $45,000 below the insured level, and you'll get a indemnity payment of $33,745 for that year.
Are any of these policies mutually exclusive?
So there are, with whole farm revenue, there are some rules about which single crop policies you can have. Sometimes you can combine them, sometimes you can't. And you need to look into that and talk to the crop insurance agent about which ones are and aren't. Which ones work together, which ones don't. I mentioned before, if you don't have that production history, you have to rely on the county yields. Quality loss indemnities are available. The example there would be apples that have some type of damage that prevents them being sold in the fresh market, and maybe they need to be diverted to processing. You can possibly get an indemnity payment for that. Okay, so in 2016, New York had record indemnities or payouts to farmers from the crop insurance program for drought. It was our largest ever. And other than 2016 and 2012, most of the time it's related to cold weather and excess moisture. That's usually the problem we have is, cold and wet in the spring. A lot of lenders like to know that you have crop insurance because it gives them some security that even if things go badly, you'll be able to make a payment. And, even if you say to them, depending on your coverage level, you bought, hey, I couldn't, we had this problem. I think when I work out the numbers, I can, give you 75% of it for the next couple months. That makes them a lot happier than saying, ooh, for the next 6 months, I think I got to do interest only, or I'm not going to pay you at all. That makes lenders grumpy in a hurry. I talked about not all single crop insurance products are available in every county for every crop. You do have an option for some of those to have a written agreement, which says, you know, we're going to use kind of the same provisions that these other policies use, but you have to go through a process with your crop insurance agent and the risk management agency. That's the link for the RMA crop insurance agent locator. So you put it in by zip code. And really, if you're looking at crop insurance for the first time, one of the things you want to do right off the bat is develop a good relationship with your crop insurance agent, because there's a lot of deadlines. There's specific ways that they want some of this information when it comes to yield data or revenue. And so if you have that good relationship, the crop insurance agent will keep you up to date. They'll, you know, let you know, hey, sales closing is coming up, or I need your yield reporting. Okay. So record keeping for crop insurance, and this is adapted from another presentation, but I want to go through this briefly. So again, because a lot of these products, you eventually get to the point where you can use your actual production history. You want to keep track of that. Detailed records also help with making sure that payments are made in a timely manner. And they help provide evidence that you're following good farm management practices. Okay, so like in the case of the prevented planting, if you've kept good records and you can show, hey, these are the dates I planted the last 2 or 3 years, this year I couldn't do it, it's a lot stronger, a lot easier for the agent to work with, rather than saying, oh, wait a minute, oh, when did I plant last year? Oh, I gotta go back through the little notebook that's on the dashboard of the truck and figure that out. And these are all generally good management practices. And I would say that for organic producers, you're probably ahead of the game on some of this record keeping because of the things, especially if you're certified, the things that you have to do for certification. Okay, you're already, you know, keeping track of where your fields are, what crops you have. So it's easier to integrate this into some, as opposed to somebody who not so much doesn't have some of those requirements. Okay. So for the APH yield, it's a 4 to 10 actual yield history if available. So once you hit year 4, then it kicks in, and then they add that 10 years on, or add each year on up to 10 years. The T yield, which is what they call that county yield, is based on a 10-year county average when you don't have that actual history. So if you have less than 4 years of records, variable T yield is used. So if you have no records, but you've grown the crop, that first year you can get 65% of the T yield, which for a lot of crops is not much. If you have 1 year records, then you get to go up to 80% of the T yields. 2 years of records, and you have 90% T yields. And new producers, so if you're a beginning farmer, you can get 100% of that T yield. For a lot of farmers, though, like I've mentioned, that T yield may not be as favorable as your own actual production history. So you have to be able to document what, where, when, and how you planted and harvested a crop. Again, that goes back to good management practices. If you're saying prevented planting because you planted a crop direct seeded that should have been a transplant, they might have some questions about that. And they have to be at whatever level you're, either at the crop insurance unit level, so like whole farm revenue, all your revenue for the farm for the crops that you decided to put in that policy, or by field level. If you're doing a different type of crop, let's say it's a corn grain or a corn farm and they've got some silage and some grain corn, there's some differences in those policies. If there's differences in practices or shares. Shares would be something probably we don't run into a lot in New York, but in the Midwest they do a lot of their grain crops based on some kind of shared yield, shared risk model. The documentation needs to be up to date, and some of these vary by crop, so they're in this thing called the Crop Insurance Handbook. Really great reading, but not something you need to go through. Usually your crop insurance agent will know those and share those with you. And it's hard sometimes I worked in county extension for a little while, having somebody come back who wanted a prevented planting claim to try to go back and figure out what the precipitation was and come up with records after the fact is really a challenge. Okay, these are some examples that you can use to separate and document production from different units. Field harvest records, something that shows we got got 25 bushels of squash out of this one field. Most of you are not using grain wagon loads to weigh your crops, I don't think. Measuring it as it goes into storage. Okay, so that might be something like an apple producer would do. As I'm putting it into the cold storage, I'm saying, oh, I've got 400 bushels in there. Yeah, we don't have any cotton. Livestock, in terms of feeding records. Even with that Pasture, the Pasture, Rangeland, and Forage policy, yeah, it kicks in automatically, but it's a good idea just as backup that you kind of have some record of maybe what kind of hay you've been feeding them supplementally, or how often you move them through their paddocks. Okay. So what they're really looking for is verifiable production records. So that's a record from a marketing outlet, a processor, a packer, a first handler, or other measurements of production stored on the farm. So the records that your crop insurance agent might have, records that the FSA has. Again, that's one of those for organic producers. You probably don't do a whole lot with having FSA records because some of yours are not, some of the things you grow aren't a program crop. And RMA, if the risk management agency has some records. I will mention, and this wasn't in the slide for whole farm revenue, one of the other things that's nice about that policy is that working with the crop insurance agent, you develop a farm plan every year. So if you have something, I don't know, let's say tomatillos, USDA probably doesn't have a tracking for tomatillo prices. Maybe they do down in Texas or New Mexico, but here in New York, we don't have a USDA price for that. That comes from a market report or something like that. If you have the documentation that says, I was selling these for, I'm just gonna use an example, this is probably not the right price, but for $4.99 a pint at the farmer's market last year, you can use that in the whole farm revenue. As long as you have the records to back it up. Okay, you can also use substantiated evidence. So, you know, ledgers or loads, if you're tracking what's coming out of each field, those will work.
What if you're growing hydroponics? Are there any agents that work with that, or insurance that work with that?
Hydroponics. A good question. Once again, see, these are questions I haven't got before, so I don't know the answer. Yeah, I don't know on that one, but can find out. Okay, so for these types of records, you should have the commodity, kind of the marketing outlet. So, you know, you may need to be keeping track of what's going for restaurant sale, what am I bringing to the farmer's market, that type of thing. The insurance holder's name, practice, type, variety, and a production quantity that can be converted to the proper unit of measure. So basically what they're saying there is there's certain things that on the federal level as part of the crop insurance, it's going to be at bushels even though you're selling it at pounds. Okay, and that's always tricky because that's a weight to volume thing. Or maybe it's something that you're selling in pounds and the usual measurement is tons. Okay, so then you have to do that conversion factor. Okay, fruits, nuts, and vegetables. The crop insurance agent is going to want a photocopy of the complete pick records. And again, this is for those single crop multi-peril type insurances. So they're looking for the names of the individuals paid by the grower, be accompanied by verifiable receipts, and include the calculations used to determine total production. Okay, and then the RMA or your crop insurance agent needs to be able to verify any of your calculations. So that's why they want it on there. So just something to think about there. Nuts, I don't think we have a nut policy in New York. That's more for the people who grow almonds and walnuts out in California. Okay. So if you don't keep acceptable, what they call acceptable records for bin measurements or weight tickets for your feeding that account for all the harvested production, you have to keep some kind of acceptable written records of the fed production to prove your APH. So this would be something if you have a forage policy, not so much that pasture, rangeland, and forage, but you can get a single crop forage policy. They want to be able to say, hey, you, instead of determining how many tons you had of alfalfa coming off of the field, you do it more by how much am I feeding to the animals. So keeping records of each feeding, and yeah, and then if you're carrying over any, okay, so from the previous year, you had some extra hay left over, you're gonna add it to this year's inventory, you have to know what the amount of the previous year's production was before you start to harvest. Okay, so we're getting to the end. Just a little bit about our project. We have a website, aganalytics.org, that has articles, fact sheets, a few presentations and videos on this information, some farmer testimonials. We're working on developing more case studies that are specific to New York, so that show, hey, these are farmers that use these policies, this is what their experience was. Developing more fact sheets and coming up with more examples of whole farm revenue protection. Okay. And there's your census reminder. Okay, are there any questions? Oh, that was a lot of information to digest in a short amount of time, and I know for a group that's new to crop insurance, it's a lot.
Where do we meet an agent?
So if you go to rma.usda.gov, that's the risk management agency website. One of the links on there will be a crop insurance agent locator, and you put in your zip code and it shows who's working in your area.
These are private insurance companies.
Right.
They take these up.
Yeah. So it's crop insurance was really designed to be a public-private partnership where the private insurance agencies are writing the policies, but the federal government is subsidizing farmers to use it, and in a certain way is also backing these policies, because it's a lot of risk for an insurance company to take on something like agriculture. So the companies said, hey, we need some federal government backing when they first came up with these.
Are those crop insurance agents well distributed around the state?
For
instance, like northern New York?
Northern New York, whereabouts?
St. Lawrence County.
St. Lawrence County. St. Lawrence County, you should be all right. It's that other northern county, the other side, Plattsburghish, that it could be. So just there's agents that sometimes also work out of state. And that's the other reason that I asked that question, because there might have been somebody in Vermont that can sell in New York. There's a few insurance agents out of Pennsylvania that cover parts of, the southern tier or central New York, where it's not too far for them to get to. Okay, anything else? Well, thank you. Last thing, so USDA has to approve all these slides, and so different people use them. My contact information isn't on there, but if you have follow-up questions, my email is D, as in dog, lw56@cornell.edu, and be happy to answer your questions or pass them on to somebody who could, like when it comes to hydroponics. Okay, thank you, everybody. Oh, well, I almost forgot. So hopefully you're all in the habit now, as we're in the second day of the conference, but those evaluation sheets are on each seat or near each seat. NOFA would like to get those back. So thank you very much. Enjoy the rest of the conference and the rest of your day.